Hey, Warren William here from Smartest Data. Live streaming portfolios and commentary on US equities every Monday around 12:30 Eastern, 6:30 p.m. in Europe. Had a bit of a disaster today, so we're 7:30 p.m. This video is created in partnership with Finscreener, and this is an extremely useful service to follow US equities. This is what I do. I perform backtests, create portfolios, and perform a variety of other tasks. Simple and convenient to use. The link is in the description below. If you wish to subscribe to Finscreener and follow me, please use it. As well as the online brokers eTORO, FX PRIMUS, and First Trade. So in the video this week, I will have a quick discussion of the US stock markets, what's going on as the indexes are approaching correction territories. A review of this week's portfolio, the 41st for 2023, and the portfolio construction process in Finscreener with my portfolios, and also using Access to monitor the investment universe, and also the watch list. Then go over a couple of stocks at the close. So that'll be Google, JP Morgan, and Goldman Sachs. So this week, stock investors have concern as the major US indexes near their correction levels. There'll be one eye on the Federal Reserve and the other eye is set on earnings. So let's take a quick look at earnings. So here we are inside of Finscreener, and as we can see here, so we open up, this is my desk, and we can look at the earnings calendar coming up for this week. So they're the overall US markets. We can narrow that down to the S&P 500, and we can also narrow that down to the NASDAQ 100. If we go back to my desk, we can see what earnings have come out. So as you can see, all up, if we go over to the NASDAQ, it's all been quite positive. So this week in the spotlight will be McDonald's, Amgen, Caterpillar, Pfizer, Advanced Micro Devices, AMD, CVS Health, Humana, Qualcomm, Airbnb, PayPal, ANG, Apple, and Moderna, and finally with Starbucks. So there's a lot of big stocks to come out later this week. The FOMC will be meeting on Wednesday, and it's widely expected that the Fed funds rate will remain unchanged. The target Fed's fund rate will thus remain between 5.25% and 5.5%. But this is not the story, but I'm going to get to that a little bit later. Nevertheless, the key message or conclusion drawn from the FOMC will be if a rate hike will occur at the December 13th meeting, and will it be more or less likely? Now, a major question is in 2024, if or when rate cuts could start. Then what will be the catalyst? Well, the major catalysts to consider are, they're all related, but they are falling inflation, a weakening economy, and then of course, rising unemployment. The US economy really still remains strong. So, but last week the major indexes fell, which was largely due to the mega cap technology corporations, and Google led the way. The S&P 500 fell 2.5%, and it was down 4 out of the 5 sessions from last week. So Friday's closing price on the S&P 500 was more than 10% below the peak reached back on July 31, which was around about 4,590 points or so. Thus, the benchmark US's indexes are entering correction territory. So 11 of the sectors finished down. The utility sector was it's a classic defensive sector, and that was one of the ones which was actually up. So let's take a look at the utilities. So what's going on here? Well, you can sort of see here, this is a sort of an economic cycle and sector rotation. So you can sort of see that really the utilities should be starting to perform in late cycle. Now, there's a recession which has been due, but so far it hasn't occurred. Last year we had the weakness on the back of a potential recession. But anyway, it's a little bit difficult to say at this point in time. I think it's just a response to the drawdown in the overall indexes. So if we go back, the recent top performers have been energy, that was down 6% on the week. Communication services, that lost more than 5%. And the top performer for 2023, technology, that fell almost 2%. A key drag on the S&P 500 index and the NASDAQ index, increasing bond yields and at the long end of the market. The yield curve, this is a trend that is set to continue. The 10-year yields increased to over 5%, currently 5.3%. The yield on the 10 years was sitting at just around 4% only 3 months ago and 3.5% 6 months ago. So it's a big concern out there. So there is a debate going on what the current data is showing and does it warrant retaining short-term long rates at the current levels. Cuts in Fed funds rate are starting to be predicted and discussed. Whilst disinflation is a very faint emerging, but it is a very real risk. I don't think it's going to occur, but if it pushes too hard, this is what can happen. And the lead time between interest rates rising and the effect on the real economy is really between 3 and 6 months. The 25 basis point increase in the 10 yields over the past 6 months is a warning sign. Keep in mind, rising yields at the long end, this is not over. The idea of, say, persistent inflation, quantitative tightening, and the likelihood of the normalization of the US yield curve could push yields up a further 100 basis points from here, with yields peaking at around 6%. Not positive for equities, as the equity market risk premium will be likely to be around about 8%. More volatile stocks could have a 12% or so. So let's go over to this week's portfolio. The portfolio has 8 stocks. So let's quickly take a look into this week's portfolio. And there are 8 stocks in the portfolio this week. So Microsoft, Google, Visa, JP Morgan, McDonald's, Stanley Black & Decker, Goldman Sachs, and Uber. So if we look at the overall portfolio allocation, so we can see financials is up at 37%, technology up at 25%, and the other sectors, consumer cyclical, industrials, communication services, all at 12.5%. If we look at the earnings ratings, a strong buy is Goldman Sachs, sellers Visa, and a strong seller are the other stocks. So JP Morgan, McDonald's, Stanley Black & Decker, Google, Microsoft, and Uber. If we look down, the stock which is giving us the greatest degree of diversification is McDonald's. If we look by sector, so technology, 2 software companies, Microsoft, Uber. In industrials, Stanley Black & Decker. Financial services, Goldman Sachs, JP Morgan, and Visa. In the credit services, that would be Visa, the other 2 banks. Consumer cyclicals, McDonald's, and communication services is Google Alphabet. The stock with the greatest upside at this point in time is Goldman Sachs. The current share price is sitting around about $290, and there's a prediction that the stock by the analysts could go up to $406. So an upside there of 40%. If we look down to the dividend and performance, no performance at the moment, but the dividend is 2.3% on the portfolio. Then on to Access, and Access is where we keep our database of stocks throughout the whole year. So we added a new one this week, which is Stanley Black & Decker. So we keep all our stocks in there. It's an extremely important part of how we manage our stocks. We're able to go back and see when various stocks were recommended. So here inside the watch list, and the watch list is basically our investment universe for all the stocks that have been recommended so far this year. So there's about 157, of course, with a new edition this week, which was Stanley Black & Decker. So you can look at various tabs up the top there. You can look at the fundamentals, technicals, price graphs, etc. to see how you'd like to slice and dice the investment universe. Let's go over to the individual. Okay, so you can see there the portfolio construction process. It's a simple sort of 10-step process that we do. So we look at the stocks we're going to pick. We do a screening via the final trades on CNBC, on the halftime report. We take those stocks, we put them in the portfolio, we mark them by market cap. Clearly this week we've got two big stocks in the portfolio, sort of Google, so that dominates the portfolio. So what we do is we take an average allocation. Anyway, let's go over to the first stock for this week, which will be Google. We'll come back and take a look inside of Finscreener at the end. Google, so the past 12 months is up 27%, year to date up 38.5%. If we look at the various valuation parameters, we can see that the forward PE ratio is currently around about 17.4 times compared to the market of 14.9 times, slightly overvalued. But then if we look at the PEG ratio, the PEG is at 1.13 as compared to a market PEG, the medium, of 2.32. Onto Google, GOOGL, a 1.35 trillion market cap company, currently trading around about $124. Look, Alphabet is a holding company, but it's basically Google. The internet media giant Google is a wholly owned subsidiary. Google generates 99% of Alphabet's revenue, of which more than 85% is from online ads. Google stock has fallen around 15% in 3 weeks. The earnings call was riddled with evasive comments with no clear path forward. Google's cloud performance may scare investors. Microsoft push generative AI, market share losses increase for Google. Google remains cheap, especially following the recent drop. If it can maintain growth. So here we're inside of Finscreener. Let's take a look at where we are with Google. So Google had a big drop off after the results and the earnings call. There was really no real commitment there. Look, Google, I think it's in a difficult position at this point in time. As you can see, most of the money is coming out of Google search. You know, YouTube, for all its strength and presence, it doesn't make much money. There's a big cost base behind it. So let's look at some of the valuation parameters for Google. Look, if we look at the forward PE, I mean, as on the overall index, you know, it's sitting at around about, you know, it's up to the sort of highest levels of the index. There's only around about 30% of stocks which are above it. So the PE at 20.14 times is expensive. But then if we look at the PEG ratio, actually, if they can achieve the growth, the stock is really, you know, what one would consider to be quite cheap. So Google for me is a little bit of a mixed bag. Let's take a look at where we are with the revenue. So revenue growth is compared to the tech sector at around about 20% over the past 5 years has not been fantastic, but of course, as compared with the overall market, it's been quite good. Anyway, so that's Google. Let's continue on with our discussion and let's take a quick look at the next stock which is coming up, which will be JP Morgan. Looking at the valuation for JP Morgan over the past 12 months, it's up 7.6%, year to date up 1.2%, so clearly trailing the indexes. The forward P is 9.4 times, which you've got to consider the banks are discounted compared to the overall sector, but this is looking relatively cheap. The issue for me is the price to book ratio of 1.6 times. I think that's expensive as compared to where banks should be, which is about 1.2 times. A solid balance sheet amid a troubled financial sector, more than $3 trillion in assets. JPM is one of the most complicated financial firms in the US and around the world. The financial performance continues to be excellent. JPM is a leader in the bank sector. Its financial performance is strong. Net profit increased 40% over 2022. And because of rising interest rates, the yield on JP Morgan's Series M preferred shares has risen. So here we're inside of Finscreener and let's take a look at JP Morgan. So let's bring it up there on the ticker. So we can see also, JP Morgan has a tough time of it just recently. The graph's been down, but it is really a financial powerhouse and a great presence in the US, the Americas, and actually global finance. It is a complicated institution to have a look at, but it has not performed year to date. It's up only 1.2%, and the forward PE ratio is at 9.5. Always keep in mind with the banks do trade at a discount and around about a 20% plus discount to the overall market. Anyway, let's take a look at some of JP Morgan's facts and figures. So we can see the graph there. Let's take a look down as to where we are regarding some of the valuation parameters. So here we are here. The current price PE ratio is 11.6 times. And the forward PE ratio is at 9.37 times. So, as compared, it's really cheap as compared to the other bank stocks as well. And it's probably the most powerful one which is out there. So as you can see there, compared to the overall S&P 500, it is really quite favorable. But always keep in mind when valuing the banks do trade at a discount to the overall market. So that's it as far as the earnings goes. Let's take a look at the revenues. So the revenue growth for the banking sector has been weak. We'll see what happens with JP Morgan coming up over the near term. Anyway, so that's it for JP Morgan. So let's go on to our next stock, which will be Goldman Sachs. Goldman Sachs is a fantastic franchise, and this is a cheap stock with a current PE of 6.7 times and a forward PE of 9.2 times. A lot does depend on the capital markets. Goldman Sachs is a leading global investment banking firm. Investment banking, 20% of net revenue. Global markets, 40%. Asset management, 25%. Consumer and wealth management, 15%. They're the segments. This has been a problem. Approximately 60% of the company's net revenue is generated in the Americas. Goldman Sachs Q3 earnings presented mixed results, a challenging market environment. Although these challenges are ultimately temporary, the stock is cheap. So there's no doubt in the world that, frankly, Goldman Sachs is very, very cheap at this point in time. It's a great franchise. Look, let's take a look over at Finscreener. So here we're inside of Finscreener, and we can see that the graph for JP Morgan, for Goldman Sachs, it's very, very steep. It's really been under a lot of pressure. Let's take a look at some of the valuation parameters that we alluded to on the tape. So if we go down, you can see the current PE ratio is at 6.7 times. That for a franchise such as Goldman Sachs is really cheap. Look, they've had their problems. There's no shadow of a doubt about it. It's been in a difficult situation. Compared to the sector, clearly that's one of the cheapest stocks which is out there, albeit that they do trade at a discount to the overall market. If we look at the forward PE of Goldman Sachs, it's sitting at 9.2 times. So there is an expected recovery in earnings which is going to come up next year sometimes. Nevertheless, this stock is really a cheap stock at this point in time. If we look at the PEG ratio, that's sitting at the lowest you'll find out there in the market. So as far as the growth which the company can offer, the PE is really at a steep discount. And one ratio which is important to look at regarding the banks, you saw there with JP Morgan, that was trading at about 1.6 times book. Goldman Sachs is trading at just over just under 1.1 times book. So this company is extremely cheap. Let's take a look at some of the earnings parameters. So earnings, it's been above JP Morgan over time. So we'll see what they can produce. There is a rebound which is expected coming up next year. So that's it for those parts. Let's look at the return on equity and ROAs. There's nothing, that has not been fantastic, which is why the stock has been severely discounted. Anyway, so if you like the videos, please like and subscribe to the channel. It really does help. And also don't forget, if you wish to subscribe to Finscreener, the link is in the comments below. It really, to follow me, and it really would help if you could use the link. Okay, apart from that, there's also the online brokers, eTORO, FX Primus, and First Trade. So see you in the next video, which will be next Monday at 12:30 Eastern or 6:30 here in Europe. Thanks a lot.